Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM 570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
This episode of Your Money with Leo Daprile is sponsored by Grange Insurance.
Leo, thank you for joining us.
Good morning, Dan. Good to see you.
Gem Young Wealth Advisors have a good Memorial Day weekend, I guess, huh?
We did. You know, one of the things about lousy weather is it forces you just to relax a little bit more.
Oh, yeah. I tell you what, my wife did some shopping on Sunday afternoon, and I was still sleeping when she got back, in and out of the Indy 500 race.
Right. Well, you know, I always said when I was on vacation, the most expensive days were rain days.
Yeah. You got it. But we had, you said you had a little bit of sunshine. You were up near the north coast there.
Yeah, we were on the northwest coast, and it was cold, but it was sunny all day Saturday, all day Sunday.
Yeah.
It was mid-60s on Sunday. It was beautiful weather up there, and I was watching your weather here. You guys were struggling.
Yeah, that's an understatement, right?
Yeah.
Yeah. We're going to talk a little bit about little advice here this morning, and we want to make sure that you folks know that you can call Leo and ask any financial question, and we're glad to help you out with that at 330-729-9977, 330-729-9977. Gem Young is a family business that does business with individuals and families that need comprehensive risk management. You'll find them in Canfield at Star Center Drive. We'll give you all that information here in a bit, but Leo is with us for the next few minutes here, so jump on board at 330-9977, 330-729-9977. When markets turn volatile.
Yes, and I've had a lot of that this year. That as the market's been more volatile this year, it's creating a lot of angst, and we all know that, but one of the nuanced part of financial planning is really trying to understand risk tolerances between husbands and wives.
Okay.
See, in many cases, we just assume them to be universal and the same, but money's like everything else. It's very emotional. People have a strong opinion towards it, and this is one of the reasons there's always conflict with money, because people just approach it from a different point of view.
You mean like somebody that you and I both know that says, I don't want to lose any money?
That's right, and you have completely different points of view. And people, and that's your DNA. It's the way you're wired.
Isn't that true, though? I mean, you think about this. If you've been a good saver over your life, you say, I don't want to lose any money, but you can't just sit on it, can you?
Well, and a lot of that comes from, Dan, Depression era people that raised their kids that saw their friends lose so much money. So it was ingrained into a lot of people not to speculate because they saw how horrific, a stock market crash could be. They saw people on the streets, people in food lines, and they wanted their best to make sure their kids never went through that. Mm-hmm. So, and again, and some people are just very conservative by their nature. And whatever your tolerance to risk is, that's neither bad nor good. So what we try to do, and we navigate a lot of clients through this, it's one of the things I think we're really good at, is we try to really drill down on what that risk tolerance is for the person. And it's more than I'm conservative or aggressive. There's a lot more that goes to that.
Well, and again, it's not that easy to arrive at that, because you start off with some basic questions. I would call this kind of a standardized test. And you just answer these questions. How, objectively, how would you feel if you lost 25% of your money in a down market? And you start moving toward a profile of that person.
Right. Well, and that's where we start, and we do have to start somewhere. But the problem with that is it's a fairly just academic approach to it.
Exactly. Yeah.
But it's not who the person is on a daily basis.
And you don't really even feel like doing it because the questions seem so rudimentary. And you say, well, all right, I'll answer them just to satisfy Leo.
Right. But as you know, then that starts the discussion.
Right.
Because we want to get in your head, and this is the behavioral finance of this business, is we want to figure out why you feel that way.
Yeah.
Were there events that made you trigger that way? For instance, I had a client come in and just said, I want to be conservative. And when we got down to the heart of it, his real fear was he was afraid of being poor.
Mm-hmm. Yeah.
So that was the real emotional triggers that went by why he didn't want to take risks. Not that he intellectually didn't understand it, not that he didn't want to take some risk, but the fear that if he was wrong would be such a devastating outcome that he didn't want to take the additional risk.
So just to feed that back, he was kind of saying to you, I'd be happy with not making a lot of money. I just don't want to lose it all.
That's right.
Yep.
And this isn't my quote, but it's a quote I heard many years ago that said more people are more afraid of being poor than they are desirous of being rich.
Yep. All right. If you want to talk to us, it's 330-729-9977, 330-729-9977. This advisor here in Sunnyvale, California, that you sent me says close to a third of his clients have tangible differences in risk tolerance. So you can be married, you're partners, but a lot of difference there.
That's why some of my clients call me their family counselor.
Mm-hmm. Yep.
Because I have the tools and we have the resources where we've been able to help people navigate this and find not even necessarily a middle ground, because I don't necessarily agree with a middle ground, because a middle ground means someone has to move outside of their comfort zone and someone has to move down in their comfort zone.
Yeah, you got it. Well, as the last couple of weeks, our first call out of the boat is our friend from Warren, and he has a question about the pandemic and the stock market. If you will, Mr. Emmanuel.
Well, good morning.
Good morning.
Well, back in, I guess, 1918, where the pandemic hit and everybody died, then came the roaring 20s. The economy, the growth came back almost to 60%, 50%, and we had the roaring 20s, a couple of decades of everybody making money. Then came the crash. My question to you is, do you think it's going to be like it was back then? And do you get in now, or do you wait, or you just, I don't know. What do you think?
Oh, lots of good questions in there. Well, I'm one of those guys that's an always-in investor. I don't stay on the sidelines trying to time the market. I don't think I'm good enough to time the market, and I don't think most people are good enough to time the market. But you have to be smart about how you get into the market, and you have to go in there with a plan, like anything else, and you have to go in there with the right managers that are taking advantage of the opportunities that this particular market today is presenting to you, because every market and every day presents opportunities. I think there's going to continue, and we're starting to see it now, and I think you're going to see more of that this year. You're going to see more volatility, because I think, and it's going to be inflation-driven and more inflation fear-driven that's going to create the volatility this year, in my opinion, than it's going to be actual economic activity, because it's going to be a different sort of volatility, because you're going to be seeing more spikes, more upward spikes, which are positive trends in the market, and who's really going to win on that. I think I heard this morning that air travel this past weekend exceeded all expectations by a lot. So to answer your point about, is this going to be the roaring 20s, I think there'll be some sort of muted version of that, because like we've talked about in the past, there's such significant amount of cash that's still on the sidelines, and people haven't spent money for a year. They're ready to go. So we're going to have that, but we're not going to crest and cliff like we did in 29, because part of the economic problems in the late 20s was there was no financial regulation. There's significant financial regulation today that exists, so that I don't think we'll go down that road. Do we run the risk of getting euphoric again and overrunning things? Sure. That's what happens. That's what we do as humans. And if that's the case, then we do run the risk of either some sort of a recession. But I think that's a long way off before we even start having that conversation.
Mm-hmm.
Well, I want to thank you. And the last thing I have to say, locally, I think Jason Kokrak might be a good investment. You guys have a nice day, okay?
Yeah, you too. Thank you for the call.
Thanks, Emmanuel. Jason, he finished second in the tournament, I think.
He won it.
Oh, he won the tournament?
He won the tournament.
Okay, I know he was second.
He was second.
Wow.
He won it. He played just a little better than Jordan Spieth. He kind of stumbled the last couple of holes, and he won it.
Oh, fantastic. Okay, I went away from it too soon. I thought he was second.
Yeah.
Okay. All right. Very good. Leo, you're telling me something I didn't know. That's good news. Jason Kokrak, huh?
Well, it was lousy weather, so I had time to read the paper.
All right. Very good. It's Dan Rivers on 570 WKBN, and we're talking with Leo Daprile here. And if you want to get a hold of us, it's 330-729-9977, 330-729-9977. Interesting. I like the Roaring 20s. The flapper music seems like everybody was having fun. They were going to speakeasies and all these kinds of things, right? The Roaring 20s. So what you're saying is coming out of the pandemic, as we did in what would it have been, 1919, 1920, coming out of the pandemic?
Yep, that's right. That's right.
9 or 10 years of good Good time. What do you think, Mike?
Well, I was just going to make a quick program note that, well, not a program note. My maternal grandmother was a flapper. She was a rebel, by God. Maybe that's where I got it from.
You watch those people. They were having a lot of fun, wasn't they?
Hell yes, they were.
So this is a little bit you plant corn, you get corn, right?
I guess so.
Yeah.
All right, our next call is on Social Security. Jeff, if you will.
Hello. My question is, I'm going to be 64 in July, and I've been diagnosed with cancer, and my oncologist says I can get you to 70, but I don't know, all bets are off after that.
No.
And so I'm wondering, when I turn 65, I know you need to sign up for one of the parts of the Social Security program, but would I be better, and what penalties might I incur by just retiring at 65? I know that would draw a lesser benefit, but I'm just curious as to Leo's thoughts about that.
Well, Jeff, I'm sorry to hear about that diagnosis, first of all, and I wish you nothing but success in with your treatment program. Well, I would say to you, you don't have to sign up for Medicare until 65, so there's no Social Security penalty for taking it early. And at this stage of the game, I would probably recommend you just take. Are you still working, Jeff? Can I ask you that?
Yeah, I'm still working, and I've saved, not a big six-figure number, but a lower, a little over that. So I have, some investments there too, so I could draw on that along with my Social Security. But I'm just trying to think of, what penalties. And I know I thought I saw somewhere until I hit my retirement at full working age would be 66 and a half at the, under the new formula. So I'm wondering, for that year and a half, what penalty might I incur, or what can't I do through Social Security?
Well, I'll give you my interpretation, but again, I always will defer the actual answer to your CPA. But if you decide to take it at 65, you can do it, and there's no penalty to do it. You do have a reduced benefit. But at this stage of the game, between 65 and 66 and a half, the amount that is reduced is, in my opinion, going to be inconsequential. Because typically when we have clients taking Social Security 2 to 2.5 years early, the break even, in other words, how much time do you have to just receive your Social Security before you break even by waiting later to take, it's typically around 12 years. So to me, it sounds like with the diagnosis that you've been given, that it makes sense for you to take it early. The only tax risk that you have is, I believe the number is, if you're making more than $19,000 in earned income, then your Social Security starts to become taxed.
Yeah. Something else, Jeff, if I can just jump in here. Really, the authority on this is a friend of ours, and his name is Sam Morocco. Mm-hmm. And he works for Leo. And if you'll call Sam, he's just a very, very nice gentleman, and he goes to my church, so I know him pretty well. But he'll walk you through all this. You don't have to buy anything unless you want to. You can invest with him if you want to. But I'm going to give you his phone number if you'll jot it down: 330-533-7941. Sam will be able to give you all the answers there, but I think Leo gave you good advice. There's really no penalty. It's just a reduced benefit, and it's prorated and all that. But Sam can give you the definitive. He'll walk you right through it, and you'll rest easy.
Okay, I appreciate that information.
All right, thank you very much. Sad diagnosis there. We hope him nothing but the best, and a lot of things can change going down the road, and hope you have a very long life. But the thing about Social Security is that I think people think, oh, there's a penalty if I wait. But what it is every month that you wait, your benefits go up. And they go up until you're age 70, and I think that's when they mature.
That's correct.
Yeah.
They cap off there.
Yeah, but it's not like one big penalty or anything like that.
In the old days, Dan, I used to be the advocate of saying to wait as long as you can to take Social Security. Right. I don't necessarily feel that way anymore. Mm-hmm. We've been doing more financial plans lately where we're projecting if you took your Social Security early, and I'm assuming these people are retired and we don't have the income tax implication on the table, and versus having to take money out of their investments, we're finding that through time, whether they take it early or not, doesn't seem to make much of a difference.
Right.
So the old day is saying we have to wait, and the risk, and where this way of thinking came from is, as you know, my clients' two biggest risks right now are outliving their money because people are living longer than they expected, and what healthcare cost is going to do to them. So then that takes us from the point of view by saying we need to make sure we preserve as much capital as we can.
Yeah.
So that's where the thought of saying, well, what if we started taking Social Security earlier than we thought? And then what does that do to the preservation of the money they saved and how we were able to grow it over time to give them more control of their money over time?
Yeah. And I think the other thing for people to think about is that you do have a restriction on how much money you can make if you say take your Social Security at 62. There's going to be, if you make over $14,000, they're going to claw some of that Social Security back. So you're going to have a reduced part-time job if that's what you choose to do, or don't work at all.
I think it's 19,000.
Is it 19 now?
Yeah, I'm pretty sure it's 19,000. That's why I gave the caveat, though. I defer that actual answer to your CPA.
Yep. And Sam Morocco knows a lot about that.
Yeah, he's got all that.
Yeah.
He's my go-to guy for these answers anyhow.
Yeah. Something that you said last week, and it continues to stick with me, annuities, they get a bad name. It seems like people have had bad experience with them because they're a contract. And I don't think we can say it enough. You have to actually look at that contract of an annuity. And there are penalties for taking those and taking your money back early on those.
My opinion is there's many good annuity contracts, and there's people that they're appropriate for. My biggest complaint is they're grossly oversold.
Yeah.
If you want the truth.
Yeah. And you sell them, and sometimes it's 50 pages long. I mean, the contract.
Nobody reads that stuff.
No. All right. I think we got time for one more call, but while we're waiting to get that call on here, let me ask you about what you do.
Sure. We're a family business that does business with individuals and families that need comprehensive risk management to their wealth and their assets. With our financial planning firm, we work with a group of folks and retired business folks and those to be retired that aspire for a work optional lifestyle. It's a lot of fun what we do. We help people achieve their dreams. We try to do it in a way everybody understands and is on board with it. We start with a fit mating to make sure that we all know each other and that we work with each other and we trust each other, more importantly, because we really get deep and personal, as you know.
All right. And Leo at Jim Young, you can email him. Tony, go ahead.
Yes, I just wanted to say I took Social Security at 62. So my break-even point is 74. But I also say, well, what's the value of those 4.5 years that I got to retire rather than work? Okay, and I says, well, that's worth at least another 4.5 years. So in my opinion, my break-even point probably be somewhere around 78 and 79. Plus, when you die, your Social Security ends, so you can't leave any of your Social Security to any of your heirs. But if I have like money in the bank or some sort of financial thing, and I pass away, that money can go to my kids.
So you actually got the money rather than waiting for it. Yeah.
Right,
There would be a point if you'd be deceased, that money would just go off. I mean, it's just done.
And Tony, to your point, that's why these decisions shouldn't just be about money. This is a quality of life decision that you made, and you had those 4.5 years of retirement most people don't get to have. Good
All right,
for
guys,
you.
I got to run, and you do too, Leo. You're going back to work, and you'll be glad to answer people's questions at your desk.
Give me a call at 330-533-6936.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.